reason we're doing this episode on looping is because you need a compelling product, right, to put in front of those people. And looping might end up being that, right, because it is only possible to do with tokenized assets and like, native issuance on chain, right? It's just far more frictionless, so you can create like a better product.
This episode is sponsored by Canton, the only public permissionless blockchain built for institutional finance. We'll hear more from Canton later in the episode. Blockworks Digital Asset Summit is back in New York, March 24th through 26th. We'll have top speakers from leading asset managers, financial institutions, DeFi protocols, crypto companies, and policymakers all under one roof. Think BlackRock, Coinbase, Robinhood, and more. Follow the link in today's show notes to buy tickets and make sure to use code BELL200 for $200 off at checkout. See you there. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another episode of Bell Curve. You got me, Myles, Xavier. Guys, how we doing?
Great to be back.
Good day, everyone.
Yep.
Myles, how's the new house treating you?
It's amazing. I don't know if I was just extremely excited about my treadmill getting here. Which, by the way, like, it's amazing. I paid gym membership fees for so long, and I would basically just go and use the treadmill. Like, it was pathetic.
I was gonna say, is this an aspirational treadmill? Is this an aspirational gift to yourself, or is this
I mean, it's not like New Year's resolution. It's more like, hey, we should like exercise again, and cut friction, right? So I think things are looking up in terms of the health wellness, index. Less so on market prices for my health and wellness, but like at least we got a treadmill on here.
You got to be locked in. You got to be on open claw. You got to be claw maxing. Come on, dude. There's no time. You can run when you're dead. You can run and be healthy when you're dead.
My agents are running over here. I'm running over here.
Apps to be vibe coded.
It's actually like it's great for when like I don't want the prompts to return to me too quickly. Like I want them to think for a good 20 minutes, and then I can just bang out a little run, come back and everything's done. It's a good deal.
This is you vertically integrating. You're like
now
a hamster wheel,
that part,
right? You're producing your own energy.
Yeah, that part's aspirational. We haven't gotten to that level of setup here. But
can I try a theory out on you guys though before we get into? We've got actually a really interesting show today on RWA looping and vaults. But so okay, wait, can I show you this? Have you seen these charts that have gotten passed around here where there is this insane growth in new websites and can you guys see my screen? Yeah. New websites, skyrocketing 40%, new iOS apps way up, GitHub code commits in the US and the UK, also all way, way, way up and to the right. I have an analogy to give you. I know Xavier's going to push back on me in this, and I know I'm the AI boomer of the show, but I think that there's again, if you're going off the idea that the friction of creating new apps goes to zero eventually, and has already gone down quite a bit, that's kind of similar to tokens. And what did you see in 2021? You kind of saw this explosion of tokens and new projects and forks that came from genuine innovations in DeFi, on-chain trading, yield farming, things like this. And one thing that I think people forget is that these things generated a ton of revenue. These weren't like empty, no economic protocols. Like the total REV that was generated back in 2021 was like 12 billion. It's like 3 times higher than it is today. So you could point to real metrics as well. So I'm just wondering, like, I think there's some analogy to be made here, right? Of a bunch of stuff that can get made, but then ultimately you need to curate. Distribution ends up mattering. It's the stuff that you put around the software, and you could see, I don't know, this kind of big boom, in AI generated apps, same way they saw a ton of new tokens. Does that resonate? Validate the the analogy, guys.
I mean, I think if you look at these graphs, all of us understand the amount of apps going live right now because of AI, but I think the main difference here actually is that tokens are tokens and they're always going to have a price attached. Whereas some of these apps are launching, but a lot of these apps are actually personal apps. So maybe they just improve someone's personal productivity and they have nothing to do with, trying to make money or, having equity attached. So I think there is some analogy there you could probably draw. The biggest analogy you can draw, I think, from this graph, if you speak to any vibe coder who is trying to make money from vibe coding, which is very difficult to do, it does come down to distribution, which of course is also a crypto problem. When there's a lot of L1s and a lot of apps and tokens, how do you attract the main audience that exists in the space, which I think is a big problem right now. But with AI, you already have these massive behemoths which have the biggest audience, which already have the distribution, which makes it harder for vibe coders. So whereas in crypto, I think we have some chains with distribution, but it's still, I think, potentially up for grabs longer term. So that's my 2 cents there.
Yeah. I don't know. My issue with your like analogy is kind of similar, right? That we can spawn a ton of tokens on pump.fun. Like there was no real differentiation between them. But there was arguably like I don't know, for a second there, a flight of investors to quality. And maybe that will actually happen more over the next 6 months to a year once the market starts to recover. But yeah, we'll get a lot of slop, just like we had a ton of shitty meme coins and if you can monetize the the abundance factor, then you're going to make a lot of money, right?
I want to maybe bring up one more point, which is actually relevant, which is a bit off topic, but there's a guy on X called YQ who actually vibe coded a new client, which is extremely performant for Ethereum. Essentially, the tweet says 2 weeks ago, I made a bet with Vitalik Buterin that one person could agentic code an Ethereum client targeting a 2030 plus roadmap. So I built ETH 2030. 702k lines of Go, 65 roadmap items, syncs with mainnet. Here's what I found. And essentially, if you just scroll through the tweet, he's saying that he has delivered what Ethereum roadmap is trying to achieve, but within a very, very short time span. If you scroll down to the bottom, he did it within a budget of about 5k, if you can see here. So he's essentially streamlining the Ethereum roadmap that is 4 years out by taking 6 days and spending 6k. So I do think now that blockchains have something similar, which is also being seen with vibe coding outside of blockchain, that even people can vibe code their own chains and clients to make these things go faster and get better over time. And so I think that blockchain is ultimately extremely impacted as well by this vibe coding phase. And it's going to be interesting to see if Ethereum and some of these larger incumbents adopt these clients, or if actually it might spark a new innovation in blockchain design in general, because I think there's actually never been a better time almost to build fast chains. The question again is like, who cares and what apps do they bring? So yeah, I found this tweet quite interesting on my feed this week.
Well, it's funny, like, first of all, Vitalik's tweeting more about AI than crypto, which tells you just about the state of things at the moment. But yeah, I guess that's a really interesting example, right? Of you can do a lot of these things, but part of the value of Ethereum and Ethereum's governance is that you have to get buy-in from everyone, right? I don't think it's just about technically shipping these upgrades. I think that would take a lot shorter time. I think the reason that for good and bad takes now, the Ethereum roadmap is too long. It has to compress. Like it's too. You can't. The idea of a 6-year roadmap is nonsensical, I think, in tech in general. But yeah, this is part of where vibe coding has to come from everyone, right? Like everyone's like, no, it's not going to come from my thing. All these other things, sure, but it just takes a little while to.
That's interesting. I haven't actually thought about like if the Ethereum roadmap would accelerate, just given the productivity boosts that we have now. I think that's a bit of that's more of a coordination problem than like an execution problem in some senses, and it's also like it's like a verification problem, right? Like you can't just be vibe coding like updates to actually like Ethereum's core clients in prod without significant security reviews, right? And so you would think like the auditors actually stand the most to benefit here, but I think they're definitely looking at either getting disrupted or transforming how they do business today, which might be good. So we don't have to all spend 500 grand every time we want to like push out, a new app or a new chain to get audited. Does been just like an underappreciated bottleneck, I think, of like smart contract development and chain development.
Before we get back into the episode, here's a quick word from our sponsor, Canton, the only public permissionless blockchain built for institutional finance.
TradFi wasn't built for 24/7 markets. DeFi wasn't built for regulated institutions. But Canton is where the power of finance meets the promise of blockchain. The only public blockchain with institutional-grade privacy, true composability, real assets, real markets. Why reinvent finance when Canton makes it work the way it should? Canton, where finance flows.
I'm going to get us to the topic of today, which is RWA vaults, or vaults, RWAs, and RWA looping. And maybe before we get into that, I think to maybe highlight and underline why I think people are so excited about this as a category is it feels like on-chain finance is really taking off with stablecoins kind of leading the way. And the story that I'm going to highlight here for people is that Meta actually just announced that they were going to be getting into the stablecoin game. And if you've been in crypto for a number of years, remember Libra happening in 2019. And look, I'm going to show this on a map. It's not quite as dramatic as I'm making it sound, but if you look at back in June of 2019, the total stablecoin market cap was like about $1 billion of total circulating supply. And then just a little while later, it was 170 billion. And so obviously not all of that is, you can't just say that Libra created all of that. Obviously it also failed. It never got off the ground. But the Zuck has a very good nose for an interesting market. I think it really made people think, wow, this is something that's real. And if you just start doing some back of the napkin math, I mean, the total Facebook universe of applications between WhatsApp, Facebook Blue, and Instagram has like 3.5 billion users. I mean, even if you just convert a very small percentage of those into stablecoin payments from their marketplace, that's somewhere around $500 billion of stablecoin market cap, right? In a very short period of time. And then you start asking, well, where does that go? It probably wants yields. And that's when it finds its way into the Morphos and the Aves of the world, into these vaults and these probably first money market like yield generating strategies. So, if you look at Morpho this week, it is ripping. It's like one of the only coins that's in the green. It's doing super well. People might disagree with this, but I think a part of the reason is front running these flows. And yeah, I want to explain the, kind of the business model that is emerging here. And maybe Myles, I'll give it to you because as you pointed out in the pre-show notes here, you were pitching this to Fidelity in 2021. Back when, because I think Yearn Finance was the original vault, automated yield strategy type protocol that like really nerd sniped a lot of people on this topic. But you just give us an overview of like what vaults are and then slot them into the history of kind of asset management wrappers that has people so excited.
Yeah, I got a bit triggered this week when I saw Fidelity had posted there was a job posting from Fidelity that was like DeFi vault product manager. And I'm like, wait a minute. I know I definitely pitched this at Fidelity a long time ago. And I looked up, like, I actually found the document and it starts off with like, there's an unmet need for turnkey but customizable solutions that abstract away the complexities associated with deploying funds into DeFi. And vaults are not new, right? Like I referenced Yearn like a bunch of times on this document. There was another class of what we call like pseudo vaults. That were more centered around this DeFi mullet, approach, right? So this were like Meow originally. There was one called Donut. And the idea was like, just make it incredibly easy for users to onboard, put money in from their bank account or from their debit card or credit card, And especially back in the day, I mean, the yield was like really, really high. If you remember, those were doing like, where it was incredibly hard to find any sort of actual like good yield because interest rates were zero, right? And so you could get like 8 or 9% in DeFi, especially when there was like a lot of demand for speculative leveraging and borrowing in order to go long on XYZ things or short, right? And it was just, I think, like way too early. To be fair, I don't think like the demand side for allocating capital into vaults has still, even like, 5, 6 years later, it still hasn't really broken out of the crypto native investor side. Like I could be wrong. We need to look at the data, but Zave, I think you were looking at something that was showing that it's fairly concentrated, right? It's like crypto native institutional funds. And okay, so like 5 years later, now instead of, so at the time I remember with Yearn, I mean the assets that like you were depositing, into, or you were borrowing and lending, these were all like just crypto native protocols or crypto native like or crypto like L1 tokens, right? There was some stable coin activity back then, but it was nothing like RWAs, right? Where we have, let's say like a tokenized private credit fund from Apollo. And if you loop that, you can get 20% APY. Or you could, loop staked Bera or staked ETH, right? Like 5 times for, the same APY. And to a crypto native, fund or high net worth individual, like that's a much more attractive, private credit's a much more attractive, like, risk reward profile, right? Like you're not going to get liquidated overnight when the market pukes. Private credit takes a lot longer to reprice, and it's just less volatile. So I think like the space has matured. I mean, the problems back then were like really around the counterparty risk. How do you know you're not like depositing into the same pool as the North Korean hackers? It was also about complexity. Sure, like even let's say if you're trying to get funds from the advisor channel, like they're not going to know how to set up a Fireblocks wallet and do manual looping themselves, right? But they might be able to do one click, from a custodian into something that's operated by Steakhouse or operated by Bitwise, who is now getting into it, right? So we've come a long way, but there's still a lot of, I think, like realized potential from in terms of like the demand side and breaking out of crypto native investors. And I think there's still like market structure issues that make it very difficult for RWA markets to be as competitive and efficient as their traditional counterparts. Yeah, that's a little bit of a history lesson and a victory lap for me, like well deserved, I think. But yeah, there we go. I'll turn it back over to you guys.
One thing that I would just to even zoom out for a second of the history of vaults in crypto is there's a history of better wrappers within asset management and money management in general. So, I mean, literally, it kind of goes across different assets, right? Like a couple, maybe just to trace how this has worked in stocks is actually Matt Levine from Bloomberg has a really great analogy about brokerages being an investment store. And we use this word financial product, but you don't necessarily always think about it like, yeah, literally just trying to wrap a strategy or type of exposure or product. That's what a financial product looks like. And the first kind of big innovation on that, not the first, but one in a series of stocks was mutual funds. And you had an active, right? Instead of just buying a bunch of different stocks, you could buy into this common fund where a really smart manager was allocating actively to these stocks. That was shitty from a tax standpoint because whenever someone sold, everyone had to pay the cap gains in the fund. Enter ETFs, which are essentially warehouse trading receipts, right? So it's a more tax advantage, just better way of getting the same thing. And I think that's what vaults ultimately are. Like you're slotting that into it's a form of asset management. Now maybe can you, Myles, help us understand outside of what these things are doing today, what are some of the fundamental advantages of vaults as a wrapper?
Yeah, no, I would also say like just to go back and look at the TradFi side of things, you have mutual funds, you have financial advisors, right? And financial advisors started off by like picking individual stocks and bonds, and then they evolved to picking individual mutual funds, right? Fixed income and equity. And more recently, they are being disrupted, and they're also like deploying into SMAs, right? So you go to Fidelity and you say like, here's my financial profile. Here are my goals. And I don't think actually like DeFi vaults are there yet, but you have personalized vault management, right? So now you have like, let's derive what this portfolio construction should look like, and how it should evolve over time based off of meeting this person's individual goals, right? If they're risk on or if they're risk off, maybe they've just retired, right? That's going to shift the construction. And so it's all the same themes, right? It's abstracting away the complexity. It's improving like personalization. It's delegating risk management. And yeah, I see the same thing basically happening and evolving with vaults today and DeFi, right? We've gone from like Xavier, you were just telling me you were trying to deploy like manually, right, into different sort of like yield farms, and it still sucks. It's really, really painful, and it's the discovery part is painful, like the actual operational complexity is painful, and the security risks that you're always worried about are really bad, right? Everybody's constantly clicking bad links that drain their wallets. Like that's untenable. That's not going to scale beyond, crypto native like experts and folks that have, let's say other motivations to be trying these things, not like putting their life savings into this. And so you're just pushing complexity up the stack, which, does introduce intermediaries, but vaults are of course different, right? Like vaults have, they allow you to maintain self-custody. But you do run into trade-offs, right? Like the more control you want to retain, probably the less flexibility the vault manager has. And so we'll start to see like some long dated, fit, like you put it in and you can't take it out for a year. You can only take it out once a month. And then like where they actually deploy into, I think is another problem. Back when I wrote this, I wrote about Aave Arc. Do you remember Aave Arc? It was a, walled garden version of Aave, right? And it just never took off because it was, could never compete with the liquidity of the main market. And frankly, like the demand side was not there. And it still was not there. What I mean by that is like the borrow side. So yeah, I think we're like, it's, still early innings, but you can see how this like roughly tracks to the TradFi evolution.
Yeah, I would agree with that. I also think there's been a lot of innovation in even like Arc has kind of evolved into Horizon, and there's more one-sided KYC, where you don't have to KYC both the borrower and the lender. That adds unnecessary friction, and there's a whole bunch of stuff that has evolved here. One thing that I would like to analyze is before we get to the RWA looping and why people are so excited about that is, can we just take a look at the value chain of vaults? And I want to understand who the different players are, who stands to benefit, and what distribution means here. Because Myles, to your point, the like RIA channel and like the wirehouses, that's a huge distribution channel for the ETFs, right? So okay, if I had to, if I had to summarize, who are the different players, or like what is the different value or the entire value chain here? There's the base execution layer, which I think you'd be tempted to say that doesn't matter. I will point out that Ethereum has a commanding lead here. For what reasons, I'm not actually 100% sure. Like in a lot of ways, I think Solana is kind of better suited. Like I think you want an environment where, you know, borrow, lend, and on-chain trading are tied at the hip, right? For a number of different reasons, liquidating being one of them, although that matters less in an RWA world. But Ethereum has critical mass for the time being. So, the base layer, the execution layer, there is the vault or lending infrastructure itself. So in this case, that could be like a Morpho or Aave or whatever. There are the actual curators. And we're starting to see like far more diversification and different types of curators. You kind of had Gauntlet and Steakhouse that started to begin with, and there were these generalists. Now you're starting to see Bitwise and actual asset managers that have a pre-existing distribution move into this space, which is super, super interesting. are the issuers themselves, so anyone that's issuing like an RWA, and then the kind of distribution, so like aggregators, brokers, sexes and earn programs are huge. Like the earn programs for sexes might be the equivalent of the RIE channel for today, but I, that's a whole already big value chain. And I guess I'm wondering, like, who do you see winning the most in this? Like, what are the most challenged parts of that chain, and who stands to benefit the most?
Yeah. I put out a tweet about this a few weeks ago. I think in that value chain, there will be a few winners across the board. I wanted to start with centralized exchanges because I think they are probably the biggest winner in terms of no matter how many strategies that go live on chain, as real world assets keep maturing and there's more assets and more choice for these curators to select from in their own sort of ETF like strategies. I think exchanges still have the users and therefore they control the economics. And so if you look at a protocol like Morpho, I do believe that some of the bigger vaults there, a lot of the TVL in those vaults actually comes directly through exchanges, which already have the users. Because still, most of the capital in these vaults, on chain at least, are predominantly retail, or like what Myles was saying, maybe like a liquid fund manager or a crypto native VC or whoever it is. So that's still the path right now. So I think that will be the path for some time. So Coinbase is winning at least right now. I think an emerging winner is someone like a Bitwise who already has the distribution, but they can actually create more interesting strategies on chain via Morpho, and they capture that whole value chain all the way from distribution to the yield and fees that they capture on a protocol like Morpho. Another winner here, I actually think, which is interesting, which I had no idea about because I spend a bit less time in the space than you guys, is actually a company like Securitize, like the kind of asset issuers, a bit similar to like Circle and stablecoins. From what I understand, they kind of own the risk compliance area within real world assets, and they're known, they have an established brand. And so people come to them to tokenize assets in the first place and get that stamp of approval. And if they have that choke point in that value chain, I think that's going to be incredibly valuable long term as well. So I feel like that space is somewhat already consolidating. So, and then the last point I want to make is the protocols themselves. So you have Morpho and Aave. I'm still on the fence around like long term, do they capture the most value in this value chain? I think they capture some value. I'm unclear as to exactly how much, but it is worth mentioning because I think Morpho for me, I always think about with vaults and curation, and I actually use Morpho and have liquidity in there, etc. Aave, for example, I haven't really used for vaults in the past, or real world assets for that matter either. But again, here, Aave's growth in the last month has like doubled their real world assets in the last 30 days or something like that, as DeFi TVL has gone down like 20-25%. So that shows me what's happening in crypto and in DeFi right now is that as DeFi TVL drops, actually reward assets continue to increase. And the question is on what platforms are they increasing? Who is the distributor of those assets? And also where is liquidity funneling in? And I think that space is drastically changing in real time right now. And for me, the jury's out long term. If I had to put capital into like who is the winner of this, I think you could have many different positions here, but it's unclear for me right now the biggest winner long term in this value chain.
Yeah. I think we'll see like vertical integration for those that own the customer relationship, they own distribution with like the managers, right? And I always kind of like reference Fidelity as that's my main point of reference, but like Fidelity wins trust both by like starting with the mutual fund managers, right? They have been like, okay, I trust giving my funds to like a guy like Will Danoff, right? Who's been managing money successfully for like 30, 40 years, manages $250 billion. And then I'm going to keep my money parked at Fidelity because I'm allocating to him. And like, whenever I want to buy a stock on my own, I'm still just going to go back to where my money sits. Right. And I could see like even Robinhood playing a role here, and it's not going to sound like DeFi vaults necessarily, but it is going to look like SMAs. And once you're there, it's like, okay, how do I ask Robinhood to do more for me that I'm willing to pay for? And my money's already there, right? And I've already built trust with them because my money hasn't, disappeared since it landed there 5 years ago. Like I could see that, and I do think that's where Bitwise is playing. And I think like the golden goose here again is like, how do you basically win the non-crypto native demand side. And Mike, you made the point earlier that what investment product has been able to break out of the crypto native bubble? It's, ETFs that just give people allow them to check the box, say I have 1% of my portfolio allocated to Bitcoin or to ETH or a mix of crypto, right? And if you were using one of Bitwise's vehicles for that, right, or if you're using BlackRock or Fidelity for that, it's very likely that you're going to look for their next product, right, that might be doing a little bit more here. So I think that's the killer use case, but I don't know if it's all about just convincing people that they, the reason we're doing this episode on looping is because you need a compelling product, right, to put in front of those people. And looping might end up being that, right, because it is only possible to do with tokenized assets and native issuance on chain, right? And it's just far more frictionless, so you can create a better product. But without it being strictly a better product than what exists outside of crypto, there's really no point for you to invest in the crypto version of this asset or this.
I mean, my question to you guys is, I don't think it would be the customer choosing for the crypto native ETF or vault, let's say, or crypto native strategies, but I think it would be someone like a Bitwise pushing that on the customer because they can generate way more fees than if they can wrap that in a way where the institution feels very, very comfortable and maybe doesn't even know that it's got any on-chain strategies to begin with, so they feel more comfortable with purchasing it in the first place. I could see that it being a more push-based approach into that market, but I wonder right now how early that market is and who are these first institutions and customers that are demanding these strategies in the first place? Or is it actually someone like a Bitwise going out to them saying, hey, you're already in this private credit fund elsewhere. We've got this on-chain. Yields are the same, maybe slightly higher. Supposedly transparency is better on-chain, less likely for anything to go wrong here. Have some of this product and see if you enjoy it.
Yeah,
I don't know how you guys figure out it.
It's probably Bitwise to large advisor shops, right? They give a presentation and then they go get all those advisors excited to sell it, right, to the actual end users that are deploying capital. So the end users have no idea. It's just going to be part of a yield sleeve, a risk, the riskier part of their fixed income allocation. That's just kind of getting constantly rebalanced. And that is the other hard part. If these RWAs do not have equivalent liquidity to what is, their the traditional counterparts, then you cannot do easy rebalancing, right? And that's a non-starter for an advisor, or a robo advisor or an SMA advisor. So I think there are some really interesting teams like Tenben that are trying to solve those more technical structural issues that allow you to say mint and redeem new shares of this RWA in a single block instead of only being able to do so at the end of the month. So yeah, once those things get solved, maybe I think there's more of a story here. But
you can also solve. We'll get into the structural challenges, but there are multiple solutions to that, right? Which is there's another, which is you can just have a different type of liquidator, right? One that's more comfortable warehousing risk for a month, instead of flipping it instantly. And actually, the point that's been made to me that I agree with is, you think about it's more like credit investors, right? This is part of the reason why credit funds are getting into the space. It's if this is a high quality asset and it kind of sold off on chain, but I'm fine holding it for a month. Maybe you have to pay them a little bit more, but you might not need an entirely different reconstruction. You just need a different type of liquidator, I would say.
I don't think that's right. I think you do need an entirely different type of construction, because the way it works today with private credit is that they will say, okay, we have $100 million, it's $100 million fund. We're going to carve out an SPV for that we're going to then tokenize, right? And but it's just going to be that slice, right? And it's not, that slice is not equal with the rest of the fund. And so to get for that slice to go significantly higher, right, it has to be less of this wrapper around an SPV or a special type of this fund. We see this with alts, to be fair. Like this is how like alts can lower ticket sizes to like 5K. This is like they have these special little wrappers that, you know, it's like a one-to-many thing. And that's actually a harder conversation with the supply side of issuers, because that's a bigger lift for them to like, you know, have a complete makeover of how they actually issue and mint these assets. And if you bring them like a very large, you know, like like amount of latent demand, then they'll be like, yeah, okay, we'll do it. We'll invest in this. All they want is AUM, right? They don't care what kind of AUM it is really. But it is a bit of a lift. Yeah.
But why is that impossible? Like, again, if you're talking about an unwind scenario, right? If you're levering up here or you're not.
No, I'm like literally talking about just like, okay, I want to rebalance my portfolio, which means I need to sell a little bit of this. Actually, I need to buy more of this, which means oh wait, there's no supply, right? Because like it's all been the SPV has been tokenized and minted. So now I have to go create a new SPV, right? And I have to get a bunch of people that will like be willing to buy that stuff. If you have like true native issuance, which is like I forget what it is. It's like, you know, the primary fund is being issued on chain. All of that goes away. But there's like these junior versions of these, you know, of these funds that like are usually what's been tokenized, or what's usually been distributed to like low tickets through advisors. And, you know, it's not like a first class citizen with the rest of the fund.
Everyone in crypto loves to talk about transparency, but would any serious business publish its payroll for the world to see or hand competitors its contracts? That's not a feature. That's a bug. And it's why most financial institutions can't operate on today's public rails. Canton Network is different. It's the only public permissionless layer 1 blockchain built with privacy at its core, sharing data only on a need-to-know basis. That's why Goldman Sachs, NASDAQ, and Broadridge are already building on the network. Only Canton delivers the network effects of a public chain with the privacy and control real finance demands. Learn more about Canton by following the link in today's show notes.
So returning just one quickly before we get into some of the looping mechanics here and the challenges, Myles, that you're alluding to, and bridging, like Dan Elitzer from Nascent called this the seam, right? The messy seam in between the DeFi and the CeFi worlds. One interesting place to maybe take a look at here is, you know, there was this kind of duopoly of curators in the form of Steakhouse and Gauntlet. Friends of the show, love both these teams. Especially got a special place in my heart for Steakhouse. But I think it's probably a little bit tough at the moment, right? Like with what they don't have is distribution. And so if you have, I think the bet was the Bitwises of the world would maybe hire the Steakhouses of the world, but it seems like they might just in-house that. And there's probably, I think that actually there's probably more, there's some very vanilla like USDC style vaults, which is super simple to rebalance and manage. There's probably some more exotic types of vaults and RWAs. I know Steakhouse has different, where they've got like their Smokehouse and their blue chip, USDC vaults. But I think that's probably the area. I know Steakhouse is a great team. I'm sure they'll figure out no way to play this. But that's the kind of part of the space which already looks like it's getting squeezed.
Yeah. Or is it just like ripe for M&A, right?
Could be ripe for M&A.
Like,
Yeah. I mean, this is topical for me personally. In the news this week, Bitwise acquired Chorus One, my former company. I think there are many similarities between the curator space and the staking space. Both are trying to generate yield and both are trying to get distribution and increase assets under management, like Myles was saying before. I think ultimately the big powerhouses, like we've talked about, someone like a Bitwise, they already have that brand, that distribution, similar to the exchanges, the custodians. They already own the assets and the customer and the end user. And I think it's really difficult to outcompete that. And if anything, I think, again, going back to our previous podcast, you have to kind of come up with some distribution strategy that is completely novel, that is able to outcompete someone like a Bitwise or someone like that, which is incredibly difficult to do. And so, Mike, you just said before, the thinking and the thesis was that eventually these asset managers would come on chain and maybe like kind of work with these more crypto native curators, etc. But it's being proven now that they want to control the economics, so much so that they've acquired Chorus One, where Chorus One has staking yield. So maybe they're going to start building vaults with staking yield mixed with some other real world asset yield on chain. So they're actually trying to almost outcompete from day one the existing curators to be the number one curators in the space, kind of, because there's so many similarities with ETFs, etc. So I don't think that crypto native curators are going to go away, like Gauntlet and Stakehouse in particular. In the staking space, you have Figment, Block Demon, you have massive brands that are still around today. They work very, very closely with banks and stuff now. So I do expect something similar with curators on chain today, with like a Stakehouse to start working with maybe some banks and helping them learn and educate. Maybe they put some capital in. We saw in the last week, one of the big asset managers, I think, was thinking about investing in Morpho itself. So this is kind of already happening, but I do think long term, it'll be the same as staking. Consolidation will happen. There will be M&A. And I think the ultimate winner is, again, the team with distribution, because it's just a yield product. Me as like a fund manager, one of the issues I see with real world assets today, without going into looping, because looping is a step above like what I'm even comfortable with myself, is any real world asset I think about deploying into on chain, there's so much friction, even for me as a non-institution or somewhat of a crypto native institution, of the KYC needed, like me understanding the number of holders, where the liquidity is, if secondary trading even happens, like where does the Oracle pull from, how are they updating NAV of the real asset. There's a lot you have to think about before you even put it in one asset itself. And so I think this space, the real asset space, is still like very, very nascent. I do think it will continue to grow, but like as someone that's trying to get more capital into real world assets, I struggle with it myself. And so that's why I think, again, on the distribution side, if Bitwise reached out to me saying, hey, Xavier, like, we know your need is this, you have this amount of capital and you want to put it on chain, and like, here's a diversified basket, and also would you like staking yield attached to whatever it is, and they have some funky stuff going on the back end. I can already see that being a very, very plausible way of going. So I think if Stakehouse and people like Gauntlet continue to get better, which I think they'll stick around, I actually think they'll eventually turn themselves into products that own the end user. I could be wrong here, but that would be like my prediction.
Let's talk about the RWA piece and the looping piece here, because people are really excited about this idea of RWA looping. And I think one analog that or maybe just a different way of phrasing this, is like looping was just a way of, it was a very specific financial workflow that was equivalent to just getting leverage, right? You were levering up. So you're taking usually a product which generated some amount of yield, like Steth is the classic one, and you're using Aave to borrow more against your position and then buy more. So you're kind of levering up your exposure and your yield there. With RWAs, there are all these complications. Myles, you were getting into this a little bit before, but yeah, what is the right word here? What makes this more challenging is that most RWAs don't confer legal ownership, and they aren't digital bearer instruments. So you can't necessarily unwind them in the same way or scale into a position in the same way that you would a digitally native bearer asset like ETH. So you need separate constructions. There are different approaches in terms of how to tackle this. But people are really excited about this because mostly the takeaway, if you look at the composition of deposits and borrowing activity that happened in Morpho and Aave, it's not on ETH. It's on USDC and USDT. So I think what people are, there's still people that want to collateralize their ETH and borrow against it, but that market is relatively small. Maker figured this out in the beginning. That's why they moved into RWAs first. And so, yeah, people are really excited about RWA looping because I think one, it's a way of injecting leverage into DeFi and not having it be purely managed by CeFi. Two, it's just a way to juice. It's like a kind of a distribution channel and way to juice, assets that are, fee generating assets for the borrow lend protocols as well. So I think that's why people are so pumped about it.
I was thinking about this before, like we hopped on, thinking about the evolution of like the supply side and the demand side of RWAs. Back when I was writing about the Yearn vaults, I remember we brought in Centrifuge to Fidelity to talk about like what they were doing, which was basically like an Aave just for RWAs, right? And if you looked at like the assets that or like the pools that you could deposit into, the amount of adverse risk was like selection that you saw was terrible. I mean, these were like really, really low quality borrowers that you were supplying USDC for. It was like forwarding like invoice, forwarding lending to truckers in Africa, and a lot of them went really wrong. I think Maple was the other one, right? And I think you would deposit in there and let like Alameda borrow from you to go do something. Like that didn't work out super well. And we actually solved that issue. So like I've, was my seat at Delta, like interested in, going after the RWA market at some point, talked to a lot of tier 1, tier 2 asset managers, and they're like, yeah, we're down to tokenize and deploy it. Like we work with Securitize, they make it super easy. Like you just bring us the demand side, right? And we'll tokenize assets on your chain. It's not hard anymore, and the assets are like decently high quality. But I don't, it's still pretty hard to drum up that side of demand. So now we've kind of solved to some extent, solved the adverse risk supply side. The demand side beyond crypto natives is really challenging. My brother-in-law works in private credit. He's like, what the hell is looping? Who's buying this shit? Like I sent him the Gauntlet article a while ago. They've like this concept is totally foreign, right? And to think that like the high net worth crypto natives are gonna be like, yeah, I would love 20% on this private credit fund instead of looping some volatile like DeFi asset or like L1 asset, right? To everybody else, that still sounds nuts, or they don't get it yet, right? And so it's going to take a little while on the education curve, just like it took a little while to get advisors to actually want to put an allocation of a Bitcoin and an ETH ETF in their portfolio. So if you can, say like, here's the traditional asset, or the traditional version of this fund, here is the looped version of this fund because it's tokenized. It earns double. And by the way, we have like the risk reward profile is like, we have historical results at this point. It's probably like a year or two from now to say that it's like, you're not going to get screwed here. Like, we're not there yet. And by the way, private credit, not as safe as people think it is. Like, just look at the amount.
That's all the people are talking about. Blue Owl.
Like BlackRock, like, or like, sorry,
Blackstone.
Like Blackstone, one of their funds, like, just had a massive liquidation. And again, to crypto natives, you're like, oh, I'm lending to like a, traditional company. Like, yeah.
There's a bunch of SaaS. There's a bunch of SaaS exposure in these big.
So there's still some issues to be felt, but the evolution of like looking at the supply side and the demand side is interesting.
You know what else is like? Do crypto natives even want private credit? I'm actually even skeptical if that's the case. I think that there was how sometimes when American companies go over to China and they're like try to copy paste and they're like, no, dude, I don't want this. I think that there's a little bit of that going on too, where I think that some of the big asset issuers looked at crypto and were like, hey, you degens, you like this risky stuff with a bunch of yield here. It's a perfect fit. But the hilarious on the crypto native side is like the institutions are here, and they're like, this feels too. They don't want it. I think there's a product market fit issue.
Well, I mean, the institutions are here on the supply side. I just don't think they're here on the demand side. And I wanted to also bring up a case study because, again, I'm not as deep as you guys, but I do actively look at deploying into some of these strategies. And one strategy I think makes a lot of sense for crypto right now in terms of timing is just like Maple Finance's recent update to like lend out to institutional borrowers. It's over collateralized. It's the kind of real world asset, Syrup USDC. It provides a yield of like, I think 5%, something like that. Like nothing really out there, but also probably more than the average yield you could get even on Morpho or Aave right now. And I think in terms of timing, they've done like a really great job there. And I actually just looked at a stat. I think they've increased their TVL like 18x in the last year, which I could be wrong, but I'm pretty sure that's the fastest growing real world asset on chain in terms of growth. And so sometimes it's just about keeping it simple in crypto as we like, we're talking about looping a lot here. Like me as someone who looks at some of these assets like Syrup USDC, like that makes a lot of sense to me. As soon as I'm a bit less sophisticated than like an active hedge fund manager, for example, which I'm sure they're more degenerate and happy leveraging up on some of these real world assets. But I think there's also a market for others that don't necessarily want to loop and just want exposure to diversified yield. And I think, Mike, you brought up a good point of like, do people want diversified yield so diversified right now in crypto where they also want private credit? And I've also spoken very closely with one private credit team in crypto, which has a phenomenal team. Shout out to Zivoe, Zivoe, if you're interested to look at them. But phenomenal team, and I think at some stage long term in crypto, they're going to have like probably hundreds of millions in TVL. But right now, the question is like that initial first customer and that first demand, and like it probably is a crypto native allocator, like someone like me or a fund manager. Then the question is, they have high yield, it's like 10 or 11%, and I think the yield is packaged in a way that makes a lot of sense. But there's a lot of education for someone like me, or even like an active hedge fund manager in crypto, to even understand on the private credit side, like how is that happening? How are they tokenizing that? How are they packaging that? It's a completely entire new risk framing that a crypto native person, even a fund manager, I think isn't necessarily native to. So I think there's a bridging of both worlds right now. And I think there's a timing thing here as well. And if I had to guess, I do think real assets are probably at least another year or two out from like real native demand. But I think timing wise, it's a good time to start thinking about it, including looping, Mike, which I know that you spend a lot of time in yourself right now. Which I want to pose a question to you, Mike, on the looping side. Like, as someone that has seen some looping strategies, I guess, go live and startups build here. Let's say, tokenized funds, which I think 3F might be working on, which I know you spend time with. I remember like sort of seeing that back in the day and finding it very interesting in how they calculate NAV, because I think that issue is not just with 3F, it's actually with many teams in the space. And liquidation of assets, like what Myles was saying, how not even tokenized funds, but even tokenized, private credit or whatever it is, there can be cases where this goes entirely wrong off chain. And in DeFi, we have up to date on chain prices and someone needs to liquidate these assets. The question I've always had is like, what if the NAV isn't up to date, and how do you actually price that in the first place? Like, I know with different funds, for example, it's even hard for managers to get the NAV up to date each quarter with their fund admin or whatever it is. So then how do you make that even more accurate in a way that a price oracle delivers that on chain? I know there's people working on this, but from what I understand, some of the biggest real assets right now, they still have like one Oracle provider, one Oracle update, maybe once a quarter. And then there's so much in between in DeFi that happens. I don't know if there needs to be more derivatives markets or hedging markets or prediction markets we could use for this. But I think that is like a category and opportunity and area I think is very interesting to then help products like 3F like really close that gap on like minimizing risk and helping people actually get more exposure on tokenized funds, leverage there. So for me, open playing field, I think there's a lot to be built, but very exciting times. And I think we'll only continue to grow in the next 2 or 3 years.
And maybe just to add real quick before Mike addresses that, like that exists in the traditional side too. So like traditionally illiquid assets like alts are trading at like larger and larger discounts now on the secondary market, right? And so I think that's kind of what we're looking at here, where there's it would be nice to have NAV actually calculated like once a day through like proof of reserves or something like that, because I think it's the Alameda issue with Maple was just like nobody knew where the money went, right? Not just Maple, broadly. But yeah, I think like it's not abnormal for like the secondary market price to be different than NAV, and that is okay. But you do not want that spread to be like extremely high, and I do think that that's probably what happens with RWAs today. If you need to get rid of it.
You guys are way overestimating my pay grade on being able to answer the specifics of something like that. All I will say is that I think, as I obviously can't speak for any individual protocol here, and yeah, it's above my pay grade. But what I will say is that generally, what you're getting paid for, I think, as being as architecting a protocol, is managing risks and coordinating different sets of actors, right? In like one network or way of operating. And like the actors that you're going to need to coordinate in something like this there are the borrowers, the lenders, the vault manager, curators, and then probably, there's like the ultimate, the liquidators as well. And I think like this is what I was getting at, Myles, with your like the point before. I think that this will be a challenge around. I think that there will be a challenge here around what it looks like to actually liquidate a bunch of this collateral. I think again, there's a different type of like if you think about what someone who's liquidating a looped stETH position looks like. That looks like an MEV style person, right? Like you're not taking any inventory risk. It's probably atomic, right? The transaction that you're putting through. Like you might not even need any capital of your own. When you think about liquidations of real world assets where you might just not have access, like there might not be, at least in the near future, right? You might just not be the nav on a data.
Don't you just hire a firm, right? Like in the same way that like Robinhood hired Citadel to just route all of their order flow, right? Don't you just have to like basically come to some agreement with a firm that they will like, okay, here are all the people that have been KYC'd and whitelisted to deploy into this pool. If it gets liquidated, like you're going to buy it and it's not going to be, and that's very different than DeFi and like, loop steth, right? Which is where, as you were saying, it's the complete polar opposite. It's like whatever MEV bot bids the highest of the next block is going to liquidate those assets and then immediately flip it for a profit. Just because it's liquid, L1 asset. So yeah, I don't know how that works. That's definitely a good call out, and probably an underappreciated challenge here.
Yeah, I want to mention one protocol which we haven't talked about in this episode, surprisingly, which is Stream Finance, which was, of course, a very recent event which involved looping, off-chain trust, recursive leverage, and also composability, like across chains. So, that is a classic case of looping that can go wrong. And I think probably timely, even though millions of dollars were lost, I think that could have been a lot worse. And shout out to the curators that didn't touch this. Like I believe someone like a Gauntlet and Stakehouse, etc., actually weren't involved in using these strategies in their own vaults and Morpho, for example. But many curators did touch this, and little did they know that Stream Finance itself was actually looping underneath with the assets that it held. So by the time that people found that out and they started withdrawing, there was a massive problem on the Oracle side, where the Oracle was still pricing XUSD, for example, which was Stream USD, at $1, when actually there was more like 30 cents on the dollar available that they had to fund and back that. And so again here, like I think the Oracle problem is potentially still open as like something that people could build for an asset like this. I think it requires more transparency, more trust, and further, like what Myles was saying, proof of reserve, stuff like that. I think we can build a lot more infrastructure in this space to get something like a 3F or these other great projects building in the space further accredited, I guess, in the space in terms of like minimizing risk and making it easier for people to trust like the underlying app. So I actually think that the apps will accrue the value. So the infrastructure we build and then something like a 3F will accrue the value long term. The question is like building that Oracle, building that proof of reserves, everything else for real world assets and looping you need to get up to speed. Because I think Stream Finance proved that we don't have the infrastructure right now, because otherwise probably that wouldn't have happened.
You solve the Oracle problem if you hard code nav at $1. It's just like, if you looked at like some of the bad cases in the past 5 years in DeFi, like it's pretty funny how many devs have just like hard coded the thing that's supposed to be 1 at 1, and then it never goes very well. I forgot about that one though.
Did you just see the different treatment that this was a big announcement from the SEC? This was new treatment that money market funds get, which is the intraday trading. You essentially do just hard code the NAV at $1, and you're shifting risk from the issuer onto the dealer side of the balance. These are like arcane, nerdy things, right? But like it's super interesting to me, right? That the official accounting treatment essentially just hard coded money market funds at $1. So
That's interesting. I didn't know that.
I'll send you the article.
If you tokenize the money market funds and you allow that to back a stable coin, right? You could actually just loop the collateral and have the stable coin pay out a lot more. That's exactly what we're talking about. But again, you don't want to hard code it at $1. Fine. It's fine. It's fine if you don't loop, right? Like for the most part.
It is. I mean, yeah, I guess it depends. It also depends. I mean, we're treating these things as if it really depends on, even when you're talking about a NAV calculation here, it really depends on what's in this stuff. Like ultimately what Vaults express and the different types of RW, there are going to be a bunch of different types of RWAs that get brought on chain here, right? And there will be some very vanilla strategies here, but there will be some pretty exotic ones as well. And I think the reason, like zooming back out to where we started, the reason why people are so excited about Vaults and Vaults is it's kind of the next generation of asset management, but it feels like a more comprehensive wrapper than almost anything that came before it, in the sense that you could very easily imagine an actively managed, stock-based ETF strategy. Like what we're talking about is something which is far more money market fund like, right? This is a very encompassing wrapper and platform to manage to facilitate asset management. It is happening at a global scale, right? Like the whole game of how distribution happens changes here too. So
yeah, it's just about figuring out PMF for like the demand side. They're just answering the why like rationally, and if you have a version of that why that can scale beyond just like, well, it's less risky than the other DeFi stuff I used to be investing in, then I think there's a chance here. But we've only talked really about private credit. I mean, there's so many different asset classes like we can, that will be touched by this, and teams are trying. Like there was an awesome team trying to tokenize munis, and it was just a rough crowd to like get into, even on the supply side, which for private credit has already been solved. The supply side of private credit is very interested in tokenizing assets. So yeah, there's a lot more room to run here, but I do think that any team should figure out the demand side first, and just how many people want to buy this stuff if they're going to go tokenize it and manage a vault that people can deploy into. Not earth shattering, but like
but it scales.
Appreciated, yeah.
It scales, and yeah, this is the phase that we're in right now. You know what? Give me like non-earth. Doesn't need to be crazy gigabrain. New primitive every other week. Give me just something that works, that like scales and people want to use. I think that's the vibe. All right, guys, we got to end it here, but this was a really fun one, and appreciate you both, and I'll see you here next week.
Have a good one, guys.